As the state's premier retirement savings plan, we spend a lot of our time educating people on the importance of saving for retirement. However, the way you manage your retirement savings after you stop working could be just as equally important. How you strategically draw down your retirement savings in order to make your money last multiple decades in retirement is called a spend down or decumulation strategy. In this DC update, we are going to quickly look at the common spend down strategies such as interest only, systematic withdrawals, the bucket approach, and annuities. With the interest-only method, you would invest your savings in interest-bearing assets, and whatever interest they earn is the money you spend for the year. For example, if you had a savings balance of $100,000 and earned 3% interest, your supplemental income for the year would be $3,000. The chart on screen illustrates the past 15 years of U.S. bond index interest rates and the annual income associated with it. As you can see, the income generated with this strategy is unpredictable. However, this strategy is typically lower risk and can help you maintain your principal savings amount. The second approach is a systematic withdrawals or installment strategy. With this method, you would make regularly scheduled withdrawals from your retirement savings account. This is a familiar strategy for retirees because it acts like a normal paycheck and provides a fairly predictable amount of money each month or year. The issue is that if you don't budget correctly, your savings may not last you through the end of your life. The bucket approach is more hands-on than the first two strategies we discussed. The idea is that you have multiple buckets of money invested differently. When needed, you would make withdrawals from the cash bucket to supplement your defined benefit pension and Social Security income. Under normal circumstances, you would periodically replenish the cash bucket by selling shares from other moderate and higher risk investment buckets. This strategy helps diversify retirement assets and could provide some investment growth opportunities. However, it's more difficult to manage unless you are a knowledgeable investor. The last spend down option is the purchase of a fixed, indexed, or variable annuity. In layman's terms, an annuity is when you hand over money to an insurance company and in exchange, you receive a regular check for a specific period of time or throughout your life. While an annuity can create a guaranteed income stream, they can be very complex, confusing, and expensive. If you do plan to purchase an annuity, please note Missouri law allows consumers a free look period. If you are unsatisfied with an annuity product within 10 days of receiving your policy or contract, you can cancel the policy and get a return of all your premium payments. Deciding on a spend down strategy can be overwhelming. However, it's important to start thinking about which strategy is best for you and your personal situation. In 2020, the Motive for Comp Plan will be launching a new seminar, Retirement Income Spend Down Strategies, for those nearing and in retirement. This presentation will take a more in-depth look at spend down strategies, investing in retirement, and helpful tips on dealing with financial professionals. Watch for an email or a website announcement regarding seminars in your area. As always, if you need direct help, please don't hesitate to give us a call at 1-800-392-0925 or reach out to your local education specialist.